You're listening to Storage Nerds Podcast, where we unravel the best-kept secret of the real estate investing world, the storage industry. Join the grassroots guru in self-storage, Stacy Rosetti, in insightful discussions about finding, funding, and running these spaces, allowing you to yield the highest returns possible. Get your foot in the door on self-storage and discover how to properly purchase facilities, negotiate with sellers, and close the deal without worries. Start unpacking that investment wisdom with Stacy right now.
Okay, good. So welcome to the Self-Storage Fund of America. I'm proud to announce that this is now live, and I'm going to be going over the offering right now. And let's see, let me go through this once I figure out how to get to the next screen. Okay, good. Yeah, good. So this is basically a statement that I just would exactly what I went over: who we are and what we do, and what where we're at, what we're looking for, right? So this is basically what it is. We're looking for $1 to $3 million properties that are mismanaged facilities, and we are going to be purchasing them and stabilizing them, and it's going to take us typically about a year, maybe 8. Depends on how mismanaged it is. If it's 25% full and it's like, a dumpy facility, it could take us longer than a 75% full facility, right? But we want to stabilize them, and then in the end, we would either sell them or refi out. In some instances, we'd be adding on as well. If we wanted to add on, we could add on. Now, we personally don't honestly add on too much. We like to buy facilities that are, that are just ready to go, ready to be managed properly. Okay. All right, so this is the introduction. This is what I'm going to be going over today. We're going to be doing an introduction, the offering characteristics, business strategy, the investment strategy, acquisition target pipeline, the investment strategy. So we're going to do how we underwrite everything, the case study. Case study is Royal Storage, the past and the pipeline investments, about Self-Storage Fund of America, and anything else. And any questions that we have, we can go over that as well too. Please ask any questions that you can think of, because it's good for me as well to be able to learn how to answer them and stuff. Okay. Okay, so the Self-Storage Fund of America and sponsor have extensive experience in acquiring, managing, and exiting self-storage and other real estate assets. Okay, so us personally, my husband and I, we've done over $20 million in asset purchase and have sold property in the last 10 years. So we do have a little bit of experience on the residential side and on the commercial side as well. So just want to point out that we focus on really mom and pop $1 million or less. We have focused on smaller mom and pop $1 million or less facilities, but this is going to be targeting the medium size facilities, and we are going to be focusing on the southeastern United States and Texas. So anywhere from like Texas to Georgia, we're always going back and forth from Texas to Georgia. We're in Texas. We're actually in Texas right now. We're looking for property in Texas as well. So we're here, and we're always, because I'm originally from Texas. My husband is from New York, but we're going back and forth from Texas to Georgia and Florida. So we figured that would be a good area for us, because we live in an RV and travel, full time. So that's like a good area for us to be driving back and forth in. Okay, let's see. Okay, so the offering. So we are trying to raise $7.875 million with the option to expand up to $10 million. The target investor leverage IRR is 19%. The hold period is 7 years with 2 1-year extensions, right? And the preferred return is 10%. The remaining cash flow splits. Basically, the way it's working is we the preferred return is 10%. Once we reach the first hurdle, there's an 8, where the first hurdle is the preferred return of 10%. Then we will have an 80-20 split, 20% to us and 80% to everybody in the fund, up to 15% IRR. Once we hit the 15% IRR, we have reached the second hurdle, and the second hurdle essentially becomes 75% to investors and 25% to the sponsor promote over the 15% IRR. Okay, so we have an incentive to try to get the highest IRR that we possibly can. And the distribution timing would be quarterly. And as soon as we have any sort of profit, we'd be paying out on a quarterly basis. And the target returns will obviously vary. Also the sponsor contribution and ownership. So the contribution will be at a 4% contribution. So that basically means that we are putting 4% in to the deal, and the promote would be a level 1, 20% after the 10% preferred return, and 15% IRR distribution. Level 2, 25% thereafter. Okay, so yeah, so it's an 80-20 split with a 10% return. Once we reach 15% IRR, then it will go to the 25%. Okay, and the minimum investment is only $25,000. The qualification to invest is that you have to be an accredited investor, which really isn't a big deal. In our back office, once you get into the back office and look at the PPM and look at everything, then essentially you'll see that there's a document that you have to sign that just basically allows you to that shows that you're an accredited investor, and then allows you to put the money in. The offering type is a Reg B. Okay, so I wanted to just go quickly over the waterfall, right, which is basically the hurdles. All right, so in tier 1, right, it's it's the 10% preferred return. The type is cumulative, and the investor puts in 96%, and we will put in 4%, and the promote is 0. So up to 2%, essentially, we make nothing. Tier 2 would be when we hit the 15% and the 15% IRR. It would be a 76% investor return, and then the 4% comes from us, and the 20% comes to us for the return. And thereafter, right, anything over 71%. Anything over the 71%, we still have that 4% in, and then you guys get the 71% split, and we get the 25% split. Okay. And I see a couple of questions. Let me just make sure. Question from earlier I don't think was answered. I answered this. Let me see, hang on. Here's a couple of questions. I want to make sure that we get those answered. Some Social Security. Some self-storage industry leaders say that the self-storage is a huge bump in values, rates, and utilization due to COVID and economic stimulus. They're saying this is probably a relative temporary effect. Once inflation reduces, investor money will shift to other assets, driving down the self-storage value. What is the longer-term strategy for the fund to avoid these possibilities? So basically this fund is for us to purchase facilities, and there's the long-term strategy of this is really to exit out, right? So we are here to stabilize the facilities, because the facilities that we buy are mismanaged facilities. So we don't have like a long-term, like there's not like a buy and hold for a specific amount of time. Essentially, our goal is to buy them, stabilize them, and then sell them. Now, and the reason why is because this fund is basically, I mean, in order for us to purchase, this fund is based off of off of debt. So we need that money now up front so we can, buy them, because we cannot go to a bank and get a loan. So our goal for this fund is essentially to just stabilize the properties and as soon as possible sell them, possibly refi them out. We could refi them out, and then we would just go to a bank and get a loan for those. All right. But for most of the facilities that we buy, we will typically just sell that property once we've stabilized it. And stabilizing it for us essentially means having having a minimum of 1 year tax returns. All right. And having a P&L, having a balance sheet, and having a rent roll that can produce us the highest value that we can possibly get within that terms. Now, the longer that we hold on to the property, so if we hold on the property for 2 years, then the better the value will be, because we'll have that tax returns, we'll have all those numbers. So it really just depends on the type of property that we buy. They will be mismanaged facilities, so it's going to take a little while for us to stabilize them. All right. So that is what the fund is for. I hope that answers your question. Okay, good. So the offering, the fees, the management fee is a 0.625%. And we really, honestly, we when we built this fund, I put this fund together, we tried to really make this fund as lucrative as we possibly could. For you guys, for the investors, because, we want to make sure that, we prove to you that we know what we're doing. So we came up with essentially a very, the terms of the fund are very aggressive and very competitive to a lot of other funds out there. So again, the management fund is 0.625% of the gross purchase price, right? So that's our management fee that we're going to be getting. So 0.625%. The acquisitions fee is 0.50% of the gross purchase price. It's a one-time fee that goes to us. There's no refinance fee. There's no disposition fee. And if we do add on, if we happen to add on, facilities, then we would get a 5% development fee on the new construction or expansion just to manage that. And we would get 7.5% as a general contractor fee. All right, which is actually very low compared to the industry standard. All right, good. So those are the fees. Let me see. And then our strategy, I've already been over this, and just to go over it, just real fast, is that we're here to buy mom and pop shops in the Southeast, across the Southeast United States and in Texas. And we are, so we've been in the industry now for 5 years. We own 11 storage facilities. We're going to hold, so we do have knowledge in what we're doing, actually what I'm saying. And we are going to hold these essentially to get them to the point where they have good tax returns, good P&L, good balance sheet, and then most likely we're going to sell those off. The company believes that the opportunities, went back. Well, I'll go to the next one. Business strategy. All right. So like I said, we are, the market is the Southeast. 10.6% of the households currently rent a self-storage facility. That's an estimated $13.5 million. 13.5 million households in the United States. And like the person asked, what is happening in the self-storage industry right now is that it is growing, and it's growing very, very fast. And we focus on mom and pop areas and the tertiary markets, right? And tertiary would really be like the secondary, where the secondary and the tertiary market end and begin is kind of where we focus on. And I'll show that to you here in just a minute when I do the example. And so we already talked about the company plans to focus on the Southeast and Texas. And Texas is one of the fastest growing states, so it's a great area to be investing in. And then again, we're talking about Southeast United States and Texas, and the markets that we picked are essentially the markets where where everybody's growing, or all the states are growing, and that's why we focus on these areas. Okay. Again, our focus is like the mid-range facilities between 15,000 and 45,000 square feet, anywhere in the Southeast, and they'll all be mom and pop shops. And we do essentially what we do is we do what we call rip the Band-Aid, which is price increase as soon as we buy the facility. We also are completely virtual. Essentially, we have not been to any of our facilities. I mean, our boots on the ground people go to our facilities, but we personally don't go to the facilities. We don't meet people at the facilities. Everybody just rents online. So we're basically remote. We're 100% remote. And so we can run our storage facilities from anywhere. All right. Okay, good. I kind of think I went over a lot of this. Let's see. The post-acquisition customer experience is that you can lease in 24 hours a day. You can move in 24 hours a day. You can pay online. You have live support from our. We have actually like a day person and the answers during the day, and then at night we have like a call center that answers. So we're always answering the phone. And right, you get the lock, you get the updated information. All right, and you could buy insurance. We offer the tenant insurance as well too for all the facilities. Let's see. Good. The pipeline we have. So as of right now, we have a pipeline of over $13 million worth of facilities. The company has identified and contacted another 83 facilities that it would make. Yeah. So essentially, what happened to us? Like what happened to us even this past weekend is Chris called out of 60 facilities that he called over this past, not this weekend, but the weekend before. 10 of them wanted to sell. Right. And so we actually have put in 5 offers on 5 facilities, and we're looking to put in a couple more here in the next couple of days. So for us, finding facilities is really not that difficult. Right. We've got that down. That's for sure. And let's see what else. The company's underwriting model is based on acquiring underperforming facilities and bringing them in line with several key measures, including vacancy, loss to lease, and operating expenses. Right. So we want to decrease the vacancy rate and decrease the loss to lease. Essentially, that just means what that's saying is that we're taking a property that is like vacant, or losing money, and we're trying to decrease the vacancy rates from 35% to 13%, and we're decreasing the loss to lease rates from 20 to 10%. This is based on like our case study that we came up with, and actually this is one of the properties that we were looking at buying. Essentially, it was 168 units. All right. And it was 25,000 square feet located on 10 acres. It's 11 buildings. And the price per square foot, the purchase price was about $35 a square foot, plus all the additional land that it came with. And then the transaction cost, it would cost about $25,000 in order for us to purchase it. And then to close on it was about $7,500. The fees were about almost $34,800 to finance it, and which would be like just the debt, a little bit of debt, and then nothing for the equity. And let's see, so total is almost $35,000 to finance it, and to oops, I keep doing that. Cannot do that. Okay. Sorry, this Zoom thing is getting in the way. So I got to move it out of the way so I can see these numbers. And let's see. Okay. So the basically the total transaction cost was about $97,000 in order to purchase this thing and to get it up, running, and ready to go. The purchase price was $620,000. The transaction cost was $97,000, and the equity was $67,000, and the debt was $650,000. So the total project cost was $717,000. All right, so this is just an example of something that we would purchase, right, within the facility. This facility is 168 units, and it was 20. It was like, I think it was about maybe 25 to 30%. I'm sorry, not 25 to 30. It was somewhere between 25 and 50% full. So the owner was not managing it properly, if I remember correctly. Let's see. And let's see what else. Okay, so these are some of the facilities that we've looked at to purchase, right? So we've looked at facilities in Valdosta, Georgia, and we do own in Valdosta. We've looked at St. Mary's, Noonan, we own in Valdosta. We've looked in Tallahassee, we've looked in Marble Falls, Texas, and we've also looked in Ellijay, Georgia, right? So we've been looking all over, basically Georgia, Florida, and then Texas for right now for the pipeline. This is my husband. This is me and my husband. You guys have met us several times, many times. And let's see, and that's it basically with that presentation. So did y'all have any questions on that? Any questions? And I'm going to look into the chat here real fast. The minimum investment is $25,000. And let me see what else we got. Somebody asked that. Lila asked, what's the minimum investment? $25,000. Okay, hang on. Didn't your slide say a hold period of 7 years plus 2 1 years? That's the time frame of the fund. That's the time frame of the fund. All right. So the fund is essentially it's 5 years. It's a 5-year fund with I guess, how do I say this? I guess it's a 5-year fund with 2 1-year extensions that are possible. Okay, so that's that. How is your investment secure? How is your investment secured? The investment secured shares of the fund. Yes, exactly. Right. So, so you'll be essentially, you're going to be putting the money in, and then you will be getting quarterly statements from us that kind of explain how we're doing and what we're doing. And then on top of that, you'll be paid out on a quarterly basis as soon as we make money, essentially, right? So it takes us a little while to make money. And then on an annual basis as well too, you'll get a report from us. And on top of that, once we sell, then you'll get paid actually the return as well. So there's kind of a whole bunch of different ways that we're doing that. Good. What else? What other questions do we have about the investment? Anything else y'all can think of? Okay, before we go, then I do want to talk about one deal that I would love to fund in this deal, and I wanted to see you get your guys' opinion on it. And I know everybody's listening in, so I appreciate that. And this one, we've put several facilities under contract over the last couple of months, and been pitching, and a lot of y'all have been listening in and watching me do all the pitching. But essentially, I wanted to just get into the deal that I'd like to fund first, right? This is the deal. And actually, let me pull up the picture so y'all can see what it looks like. So it's actually 2 facilities in Franklin, Georgia. And I'll show you, they're almost brand new facilities. So let me see if I can find like a good picture for you guys to see. And this one has a commercial property on it. And so this one, the commercial property is making $1,500 a month. All right. And then the facility itself looks like this. It's almost a brand new facility. This right here, you could see is the commercial property. And then this here is the facility, right? So you can see here, it's pretty nice looking. It's just it has a regular storage facility. It looks just like this. And the owner, so essentially the owner is sick. And we own a storage facility right around the corner from this one. And let me see if I can pull up Google Maps. And you guys could just check it out. So it's Google Maps, go to Miss Lillian's, just type in Miss Lillian self-storage. And it should take you to all of our facilities. And this one here is in Franklin, Georgia. And it is, let me see if I can find it. Yeah, it's right here. This is Franklin, Georgia, right here. Okay. So the two facilities that we're going to buy are in this area as well too. So Franklin is a small town in a tertiary market in Georgia. We own a facility already there. Okay, we own this facility, and the owner called us up and basically said that he's sick and he wants to sell. And I can't remember if Chris called him. I can't remember if Chris called him or if the owner called us up, but essentially he wants to sell. He's not doing very good. He doesn't really have a lot of time to manage this thing. He has a full-time job, and he just honestly doesn't want it anymore. He just doesn't want it anymore. And so there's two of these facilities. All right. So I wanted to just show you kind of like, what the storage facilities look like. They're both kind of newer facilities. I think one was built in like 2017. One was built in 2020. And let me see if I can show you this here. You can see, yeah. So now they're both on 5 acres of land as well too. So they're both on 5 acres. They have a lot of room to be able to grow and expand. All right. And I've already talked to the county, and the county said that definitely you can just grow. You can just build if you want to build. So there's not an issue if we ever wanted to do that. But we own the Franklin, the one right around the corner, and he has two facilities. This one, and let me see if I could pull the other one up. It's going the other way. Hang on. This one and then this one right here. So you can see it's kind of a triangle. And this is all buildable. This is all buildable. We could add more units. He's 100% full. All right. He is making $150,000 a year on this facility. Okay. And it's about, let me see if we look at the numbers, right? Yeah. It's 157 units. It's 18,400 square feet. Okay. He's charging exactly the same price that we're charging, right? So we're at the same price. So essentially what would happen is when we buy these two facilities, we will increase the rates. We'll probably increase them to 65 cents a square foot, but over time we'll probably get them to even 70 cents a square foot. I think like we could get these to 70 cents a square foot, in the next couple of months or so. And he's making, so it's $126,000 plus he's making for the commercial building $18,000, and he's making $5,000 a month for for boat and RV parking. So total, he's making around $150,000 a month, right? Here's our operating expenses. So essentially it's going to cost us roughly around $40,000 a year to manage this thing. All right. And the NOI comes out to $106,000, right? So this NOI is essentially, the number that everybody should be looking at, because this is what we'll be looking at, for like for the fund, right? What, how much money are we going to be making? This is what we're going to be making right here in the end afterwards. So we'll be making about $100,000 a year. Now, as you can see here, I know it's kind of hard to look at the deal analyzer, but it's valued at about $1.3 million as is, 1.329. All right. Once we increase the price to 65 cents, which we'll do that immediately, not only to our facility, but also to these two facilities, we'll increase the price to 65 cents, and it will be a value of 1.4. So there's already equity in this deal. There's already $400,000 in equity in the deal. And on top of that, we will eventually be increasing the prices, over time we'll increase the price to, I'm guessing around 70 cents. Oops. I'll make sure we can look at that to just see. So just by doing, over the next year and a half, stabilizing this and getting it to become a property that you can actually fund because the owner only takes cash. That's it. He only takes cash. So he has no numbers at all, right? That's why it's considered a mismanaged facility. So it'll be valued about $1.5 million. So essentially it's taking it from a 10 cap to a 12 cap. And and then splitting the money for that and what we make on that. And then if we decide to later build on, I could raise the money and then build on. We could also build on as well too. But this is the very first deal that I would like to put into the fund. And I think this would be a good first one because really it's just stabilizing it. It's not even that mismanaged. The only thing that's really mismanaged about it is that it's there's no P&L, there's no balance sheet, nothing. He has nothing at all. He has no numbers to show at all. But it is 100% full. We've been around, we've looked at the whole thing. He says his physical occupancy and his economic occupancy are very high. Everybody's paying. He doesn't really have any issues. He rarely ever does any auctions. And the truth is I know this to be true because we have a facility right around the corner, which is kind of the same thing, right? And we don't really have any issues with that facility at all. Every once in a while we have to do auctions, but it's not like that big of a deal or anything. So I think this is a very good first facility for this fund. And so I'm going to be trying to raise the $1 million in order to buy this, and then we can all share in the profits. And so that's really, I wanted to show you all, that's the first deal for this. That's the first deal for this fund. Okay, so any questions on that? Let me just check. No, the hurdles are not per deal. The hurdles are for the fund. So the sooner you get your money into the fund, then the more money you're making, the sooner you'll be able to get those returns back. Okay. So that's why I'll be pitching this over the course of the next couple of weeks. And, really trying to get better at pitching it. And then it's really raising the money right now so that we can get out there and buy a whole bunch of facilities, within the next couple of months. Okay. And this facility right here that I just showed you, the Franklin one that we want to close, we're closing this in the next month. So whoever gets in now, it's really this going to benefit you the most because you'll be able to, reap in the benefits of this facility, which will be making money immediately as soon as we buy it. So this really would be considered an income producing property if we could take it to a bank and get a loan, but we can't take it to a bank and get a loan because there's no P&L and balance sheet. So really, I feel like this facility, the Franklin facility, is only going to take us about a year to really to stabilize, get up and stabilize. And then we'll just have to decide internally, and I'll talk to Rob and to Pete, my husband, and we'll decide when we're ready to sell this property. And then what I was thinking too, also to sweeten the deal, is if we do decide to sell the Franklin facility, we'll just add our Franklin facility into it. And then we'll create a little mini portfolio that we can sell to everybody. Okay, so that was what I was thinking on this as well. So we'll just kind of sell the whole thing, and we can take ours and 1031 exchange it to something, and everybody can get their returns. So I'm guessing this is not really a very long hold for this facility. Okay. Okay, good. All right. Anybody else? And do investors have to keep their money for the entire length of the time? Yes. Yes. As I said, so once you put it in, then you're putting this money in. So you want to make sure that that this is, but you will be getting returns back. I mean, on a quarterly basis, you'll get something back, but yes, when you put the money in, that's for the term of the fund. What does Alan think about funding the deal you were telling us about? Alan who? Alan Cowgill? Alan? No, he doesn't know anything about storage facilities. Alan is he teaches people how to raise money. Yeah, Alan teaches people how to raise money. He focuses on residential, but he does teach people how to, to start funds and things like that. But actually the truth is this fund is the terms are very high. We try to really make them very competitive for everybody. All right. So, so what you'll do is just go to Self Storage Fund of America, and then you can go to the website, check it all out. And you can get access to the PPM. I'm going to give everybody access to the PPM tonight. You'll be able to take a look at everything, check it all out, and then you guys can make a decision. Like I said, the minimum is $25,000, and the goal is to buy this facility and close in the next 30 days. All right. So we're going to be ready to go, and get this thing going. Yeah, Alan is a good friend of mine. Yeah, Alan is a very close friend. I talk to him on a regular basis. So, okay, good. Who else? Any final questions? I'm going to go. So now I apologize, but I got to go to another webinar. I'm going to be hopping on to the next webinar. So let's go ahead and end this, and I will see you guys at the next session. Thank you for hanging in there. Take care.
Thank you for joining us for this episode of Storage Nerds. Hope this informative conversation inspired you to go out there and jump into this highly profitable business venture that people rarely talk about. Get more tips on storage space investing at www.stacyrosetti.com. Don't forget to subscribe to the show and leave a rating. Together, let's build that thriving passive income one storage space at a time. Until next time.